For more than 100 years, Brown-Forman has been the very definition of a blue chip stock, a real titan of American spirits. But right now, this iconic company is facing its biggest test in decades. So, if you're looking at this as an investor, you have to ask, is this a crisis or is it a super rare opportunity? Let's dig in and look at both sides of the coin.
Okay, so here's the story in a nutshell. You've got this company with an unbelievable 155-year legacy. We're talking pure quality and dominance. But now, all of a sudden, it's grappling with slowing growth, a market that's totally shifting under its feet, and it's making this massive, really risky strategic change. It's kind of like that classic story, right? The established champ suddenly has to face a brand new fight. Now, to really get what's at stake here, we first have to talk about just how strong this company is. I mean, for generations, Brown-Forman has built one of the most durable competitive advantages, what investors call a moat, in the entire consumer industry. It's seriously impressive. And this all goes way, way back to 1870. It started with this simple promise from its founder, George Garvin Brown. And look, this wasn't just some catchy marketing slogan. No, it became the company's entire guiding philosophy, a totally relentless focus on quality and premium products that has literally defined their strategy for over 150 years. And believe me, that philosophy translates directly into some serious market power. I mean, in its home turf, the American whiskey market, Brown-Forman isn't just a leader. It's an absolute giant. A 34% market share? That's more than double its closest competitor. This, right here, is what dominance looks like. So this dominance really rests on three key pillars, and these are the things that have made it an investor favorite for decades. First, you've got those iconic, totally irreplaceable brands like Jack Daniel's. Second, the shareholder returns are just incredible. I mean, this is a dividend aristocrat that's increased its dividend for 41 straight years. Wow. And third, it's family controlled, which lets them think truly long term, without all the short-term market noise. All right, but that incredibly strong foundation we just talked about, it's now being shaken. The super smooth ride that investors have enjoyed for years is suddenly getting very, very bumpy. And it all starts with a major shift in how people are spending their money.
You see, for years, the entire spirits industry was riding this amazing wave called premiumization. It's a simple idea, really. People were choosing to drink better, not necessarily more. Brown-Forman's whole strategy was built on this trend. But now, with all the economic uncertainty out there, that powerful trend is just hitting a wall. We're seeing industry reports, and even the company's own CEO is calling it stagnant. That's a huge deal.
Okay, but it's not all doom and gloom. There is a huge bright spot here. If you look inside their portfolio, their super premium brand, Woodford Reserve, is absolutely killing it. Sales are up 8%. And that really proves that the right brand can still command that premium price and pull in customers, even when things are tough.
But, and this is a big but, here's the flip side. While whiskey is their strength, their big push into the super competitive tequila market, it's really struggling. We're talking a double-digit sales decline for their Herradura and El Jimador brands. That points to a major challenge and just goes to show how hard it is to win when you step outside your main wheelhouse.
And this really highlights what the company itself points to as a major vulnerability, something called concentration risk. Basically, when your other projects, your other growth engines are sputtering, you become dangerously dependent on the health of just one single brand family, Jack Daniel's. And that means any weakness there has a massive ripple effect across the entire company. So, how is management responding to all this pressure? Well, they are not playing it safe. In fact, they're undertaking the single biggest strategic pivot in the company's modern history. We're talking about a really high-stakes bet on the future.
What are they doing? They are completely overhauling their U.S. distribution network for the first time in over 60 years. Just let that sink in. This is exactly the kind of bold, long-term move that's only possible because of that family control we talked about. They're willing to absorb some real pain right now for a potential payoff years down the line. The goal, of course, is to reignite that premium growth, but man, the transition is a massive, massive undertaking. And they're being totally upfront about the risk here. Management has explicitly told investors to brace for short-term disruption and volatility. Now, in the investing world, those are words you pay very close attention to. It's basically a warning sign that things could get worse before they get better. And listen, this distribution overhaul is just one piece of a much bigger shakeup. They're also doubling down on huge growth areas, like the massive global launch of Jack and Coconut Can. They're buying their way into new premium categories, like acquiring diplomatical rum. And they're trimming the fat, selling off brands that don't quite fit, like Finlandia vodka, to really sharpen their focus.
Which, of course, brings us to the ultimate question for any investor. What does all this mean for the stock price? After hearing all the good, the bad, and the downright risky, is this premium company finally on sale? Well, the market has delivered a pretty brutal verdict so far. Over the past year, the stock has just been hammered down almost 40%. That number right there, that reflects all the uncertainty and all the fear that we've just been talking about. But what's so fascinating is that even after that huge drop, the market still gives Brown-Forman a premium valuation. If you look at key metrics like EV to sales or the PE ratio, it still trades for a lot more than its huge competitors like Diageo. And what that tells you is that investors still believe this is a higher quality business, despite all the recent trouble. And this right here creates the central puzzle for investors today. On the one hand, yeah, the stock looks expensive compared to its peers. But on the other hand, it looks pretty cheap compared to its own history. Its current PE ratio is floating around 22, which is way below its 5-year average of over 30. So the big question is, are you buying a premium company at a rare discount, or are you overpaying for a business that's facing a fundamental slowdown? And that leaves us with the final big question. Are we watching a giant stumble here, just weighed down by slowing trends and all these risky changes? Or is this a high-quality company that's like a coiled spring, just absorbing some short-term pain and building up pressure for a huge rebound? That is the multi-billion-dollar question the market is trying to answer right now.